Good afternoon, ladies and gentlemen, and welcome to the K3 Capital Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you when they're ready for your review. Before we begin, we would like to submit the following poll. If you'd give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Andy Melbourne, CFO, and John Rigby, CEO. Good afternoon.
Good afternoon, Mark. Thank you for the introduction, and welcome everyone to H1 FY22 results presentation from K3 Capital. And if you can just go on to the introduction slide, I think everybody knows who we are. Starting with group highlights. H1 has seen us continue to build what we see as a resilient and a diversified group, which comprises of multiple service lines, therefore multiple revenue and profit streams across each of the three divisions. As a steer to the sort of depth and quality of those revenues, and just to give you a flavour, the group issued over 4,200 invoices in H1 alone, so averaging over 700 invoices per month, with an average value of around £7,250 per invoice. So I think really just underlying the broad spread and base of SMEs that we advise on a monthly basis. We've seen a blend of organic and also inorganic growth, which sees K3 revenues increase by 73% and EBITDA increase by 62% in the period versus H1 FY21. Early in H1, as those of you that follow us will know, we completed a 10 million fundraise to acquire the Knight group of businesses, bringing Knight corporate finance and sector specialism into our M&A business and further scale in Knight R&D into our R&D offering. And that acquired growth has been complemented by the launch of new service lines. So K3 Tax Advisory and Knight Transaction Services both commenced trading early in the period and have enjoyed strong cross-selling opportunities from within the group and are already starting to contribute to group revenue and profits. And I'll provide some more colour around those later. A busy period on the people front sees us building our senior management team in line with our ambitions as a group. So we have a corporate development director now who joined us during H1, looking specifically at acquisitions and then ultimately at integration of those acquisitions. And a new group MD has been hired who joins the business during H2. He was previously MD of a global business services group with 1,000 staff and 200 million of revenue. So a high caliber individual who we very much look forward to working alongside in the longer term development of the business. Overall, in terms of staff, our headcount has grown to around 550 people now across the divisions, which is up from just under 400 this time 12 months ago, as we build our capacity and as we expand our capabilities across all divisions of the group. I'm pleased today to be announcing to shareholders a 4p interim dividend, which is a 33% increase on the 3p interim dividend paid last year. And with the strong foundations laid by our H1 performance and a good start to H2, we certainly remain confident in delivery of market expectations for the full year. Over the page on to group financial highlights. The period sees revenues up 73% to 31.2 million versus the 18 million achieved in H1 last year. EBITDA increases by 62% to 9.4 million versus the 5.8 million in the corresponding half, with net cash now standing at 8.8 million. This is after earn-out payments of 3 million plus and dividend payments in the period totaling in excess of 6 million. Our margin, as expected, is around 30%, and this, as we've said prior, is a blend of our M&A and our tax divisions at roughly 50% EBITDA margin, and our restructuring division at roughly 20% EBITDA margin. So giving a blended average across the three of around 30%. Interim dividends, as I mentioned prior page, is 4p. It's a third of our stated 12.1 pence per share for the year, and our headline EPS is up to 9.4 pence per share, an increase of 31% on the 7.2 pence per share last H1. On page 5, we thought it'd be useful to show a revenue and profit bridge, and whilst not necessarily comparing apples with apples due to the timing of acquisitions in the previous period, it starts to paint a picture of where that growth is coming from. So revenue of 18 million last H1 has grown by 3.9 million in the M&A division. It's grown by 2.2 million in the tax division and by 7.1 million in the restructuring division to give us 31.2 million for the period, an increase of 13.2 million. That 13.2 million of revenue growth can be broken down as 9.7 million or 73% of organic growth and 3.5 million or 23% of inorganic or acquired growth. EBITDA growth has been achieved across all three divisions as well, with M&A adding 2.1 million, tax adding 1 million, and restructuring adding 0.7 million, with then a small increase in PLC costs taking us to 9.4 million for the half. Again, that 3.6 million of EBITDA growth can be apportioned as 1.6 million or 45% organic and 2 million or 55% inorganic or acquired growth. Over the page on page 6, we see the group structure, and we have sections later on each of the individual divisions, but just to really pick up on some of the key highlights and the key messages. I think firstly, in the M&A division, our key brands have performed very well in the half, displaying strong organic growth and a really successful trading period, with the volume brands, so Knightsbridge Commercial, KBS Corporate, delivering 95% of the revenues in the half. Our market mapping and debt advisory businesses continue to build momentum and fee pipelines for the future, and the Knight CF business acquired in month 2 of the half, so now contributing 5 months trading towards the numbers. In July, finally, we launched the Knight Transaction Services business, which is already starting to contribute and really underlining why we launched this new service line and the cross-sell opportunity that exists within the group. So Knight Transaction Services was launched in July, so 5 months trading from a standing start. The original 3 staff that came to us from Grant Thornton has now grown to 6. Around £250,000 has been invoiced in the period, a third of which has come from their own contacts and 2/3 of which has come from cross-referral within the K3 group. And the team are now regularly invoicing 50-60k plus per month, with a clear plan to grow the team, grow the top line, and ultimately grow the contribution towards group performance. Moving on to restructuring, the restructuring division has continued to expand both nationally and internationally and grow its market share, despite the continuing subdued market conditions, shall we say, during H1, on the back of a sort of longer term or longer than expected tail of the pandemic. So Quantum is starting to see inquiry levels rising in line with the sort of broader industry statistics and the broader commentary on the market, which very much shows the number of insolvencies starting to return to pre-pandemic levels. There is, however, obviously a clear time delay in terms of those inquiries coming through to work wins and ultimately coming through to chargeable time and profit. But certainly it feels like the restructuring sector is on the upward curve. We've continued to build our staff base and importantly our fee earner base to allow us to grow organically as the market returns. And whilst we've made no specific acquisitions in the period, we have continued to consider and review a number of potential regional bolt-on opportunities, and we look forward to updating you further in due course. We've worked hard in the period also to develop our overseas office network, and we're delighted with the advancements made in this regard. So without the significant costs associated with acquiring an overseas business, we now have teams in Cyprus, the Caribbean, in Cayman and BVI, in Dubai, in Singapore, and in fact in Poland as well. And whilst the setup costs of this has caused a small margin drag in the period, we are starting to see work wins and good collaboration between the UK and the international offices, with some quite sizable and potentially quite lucrative jobs and some encouraging work wins coming through now. From a tax perspective, I think the tax division has really developed since this point last year, and with the acquisition of Knight bringing scale to the R&D revenues and the launch of K3 Tax Advisory, alongside the acquisition of Intax during the previous period, we have a far more diversified and greater scale now to our tax division than at this point last year. So Knight R&D joined the group in early July, so contributes circa 5 months to the H1 numbers. The team has settled in well and is performing very much in line with expectations. And again, a new service line launch, K3 Tax Advisory, which is a big highlight for me, is this acceleration of progress within that business. So it was launched in June at the start of H1. The original 2 partners who were headhunted from PKF down in the southwest. That team's now grown to 6. Work wins are increasing. They're now again regularly billing over 50, 60k per month. And of the 300k invoiced so far, around half of that has come from cross-sell within the group, with around half coming from external work referrers. Again, underlying the strategic benefit of launching these complementary service lines within K3. So the tax division now really is a sizable contributor to group performance and group success. Consensus for FY22 is around 10 million of revenue at a 50% margin, contributing around 5 million of EBITDA, and the teams are certainly well on track to deliver that. Over the page in terms of distribution and recognising as we do that organic growth really is the holy grail for us, with acquired growth or inorganic growth hopefully being the icing on the cake. We are continuing to work on and develop our 3 distribution platforms, as we term them, across the group. So firstly, on the left, Globe, which is our sales and marketing software. It allows us to really leverage the value of our SME data set that we hold. It's the key driver of the significant organic growth that you will see within the M&A business. And we'll look at some of the KPIs later, but the growing volumes of sellers and the growing volumes of buyers and ultimately transactions is all being driven by this data and this technology. And Globe itself fuels roughly 95% of the revenues that are generated by the M&A division. So it's a key factor in that success. Rand Globe, which is a duplicate of that system, is also assisting in developing and accelerating the client acquisition strategy of the R&D offering. And we'll show you some KPIs on that later to show how that is really facilitating the growth in the client base of Rand. K3 Hub and our wider professional referrer network continues to develop. We now have approaching 2,000 members and introducers across close to 1,000 firms, and numerous projects ongoing to generate sort of growing activity levels in terms of sales and business development opportunities from this network. Currently, this is a major feeder of work into the restructuring division, and we're now running divisional campaigns to try and drive revenues into each business division alongside restructuring. So Quantium currently generates a significant proportion of their revenues from the referrer base of lawyers and accountants, and we see K3 Hub as a natural way really of developing this footprint and in time and hopefully enjoying similar success stories in the other 2 divisions. And lastly, cross-sell. We're developing incentive schemes, communication, education within the teams to promote as much of this as possible and try to create an environment where it occurs naturally between the businesses. And we're certainly starting to see some strong evidence of this. As an example, as I've talked about already, the K3 Tax Advisory business, 50% of revenues coming from cross-sell. And in the Knight Transaction Services business, 2/3 of revenues coming from cross-sell. Almost all the debt advisory pipelines from cross-sell, and there's many stories of clients being referred across the group and additional revenues being generated or clients taking advantage of more than one product. A couple of slides now on strategy, and as we talked probably 18 months or so ago when our EBITDA was 6.8 million back in financial year 20, we had a short-term goal post the acquisitions of Quantium and Rand to reach 25 million EBITDA and a mid-term goal of 50 million plus EBITDA. And I hope that in many respects, both through what we're delivering in growth and trading performance, but also how the group is expanding, that we're proving our strategy and delivering exactly what we said we would. What we wanted to do on the next few slides really is just build this picture and articulate this story a little bit further as to how we see the build out into a 50 million plus EBITDA business through this blend of organic and inorganic growth. So page 9 talks about the first layer of that strategy, which is the continued build out of our existing 3 divisions. And this we see as coming through both organic and inorganic in much the same way that it has over the last 18 months or so. And these are really examples of what has and what can be achieved going forward. So, organically, it's about how we use our distribution to drive revenues and to grow market share. Whether that be K3 Globe, the technology, the data, whether it be K3 Hub, or whether it be through cross-selling as we've done in Knight Transaction Services and Tax Advisory. So launching these new service lines, being able to feed those service lines through cross-referrals and bundling products together is clearly a strong driver of organic growth. And equally expanding our office network, such as the office openings that are touched on in Dubai and Singapore and in the Caribbean. Again, all ways of driving organic growth. Inorganically, it's about acquisition of complementary geographies, either in the UK or potentially overseas. Also, potentially the acquisition of complementary service lines. So Knight Corporate Finance, Knight R&D, the Intact acquisitions, all examples of how we are or have acquired complementary service lines into the 3 divisions that we already hold. And then really, I guess, spanning both is growing and developing our fee earner base, which can obviously come through recruitment, lateral hires of individuals or teams, or indeed through acquiring fee earners within our acquisitions. And fee earner numbers in the consumer business over the period are 32% ahead of where they were last year. Page 10 then is often what we refer to as the second layer of strategy, or sometimes referred to as our 4th leg. These are some of the attributes that typically we would be looking for within these acquisitions. Ideally, we would want an acquisition to possess as many of these attributes as possible. Some of them are essential must-haves, some of them are nice-to-haves, but SME focused is clearly very important to us. All our businesses within the group service UK SME. All the acquisitions we've made to date have been highly accretive, earnings enhancing, and then there's lots of attributes in there where clearly we would be keen to tick as many of those boxes as possible. I think what's also important is, and we wanted to articulate, is this isn't just about financial engineering. So this isn't just about acquiring a business at a multiple lower than our current rating. This is about us really starting to add value to these acquisitions and help them to grow and flourish as part of the K3 family. And that really centres around a number of things that are listed on the right-hand side here. So firstly, giving owners of businesses a more entrepreneurial home. So, running a business can be a lonely place, and being able to surround yourself with like-minded, forward-thinking, experienced entrepreneurial people is an attractive trait of being part of K3. Clearly we bring that PLC status, that halo effect, and the credibility that comes with being a PLC. And that has allowed some of our existing businesses to move up through the value chain. And we see, in the same way as we have done perhaps in the M&A business, that other acquired businesses will be able to take advantage of that PLC status also. We can assist in allowing the entrepreneur to flourish and grow their business by absorbing some of those centralized functions. So things such as finance, HR, compliance, and even maybe data and marketing can all form part of a centralized function that, again, allows those business leaders to really concentrate on growth. We can obviously also help with management and staff incentivization. So schemes such as the Save As You Earn scheme, growth shares, really helping to incentivize people and also tie key people into those businesses for the medium to long term. And last but by no means least, we can help them to grow faster by plugging them into our SME distribution platforms that I touched on earlier, whether that be Globe, Hub or cross-sell. And finally on strategy over the next page is really, we've talked about this ambition to be a 50 million EBITDA business. And we wanted to illustrate in numbers an illustrative example of what that could look like. And we lay out here just sort of one route of how to get to 50 million plus EBITDA. So firstly, in the top section, we see a clear runway ahead to drive the existing 3 divisions to a group of mid-30s EBITDA over the medium term. And this illustrates where that growth would come, potentially across the M&A, the restructuring and the tax divisions. The additive effect then of 1 or 2 meaningful acquisitions of a size, and we've put here of initially 5 million EBITDA, which could potentially then be accelerated, that growth be accelerated as part of the group. That is how we see the overall business getting to 50 million EBITDA. Now, it may be that those illustrative acquisitions would be a 4th or a 5th leg, or it may even be that 1 or both or more of those could fall within the existing divisions that we have. Obviously, until we have particular targets in mind to talk to you about, it's very difficult to say. But that's just to give a flavour of how we see that as a blend of growth of the existing divisions and then potentially more meaningful acquisitions alongside of that to really accelerate that growth up to that 50 million EBITDA group. Okay, what I'm going to do now is just split out into the 3 divisions just to talk in a bit more detail about the performance of each of the 3 over the period. So firstly, the M&A division. And really, we couldn't be more proud and delighted, given everything that's gone on over the last 2 years, to see how the M&A business has shown resilience and bounced back from clearly what was a very challenging period in UK SME world. So that fantastic momentum that we had in H2 of last year has really carried through into H1 of FY22 to deliver a really strong half. So we can report significant double-digit organic growth, and that's been complemented by the acquisition of the Knight CF business earlier on in H1. And that takes revenues within the M&A division to 9.8 million in the period. That's 66% ahead of prior H1. And EBITDA increases to 5 million, some 72% up on prior H1. The KPIs and monitoring and performance, which I'll come on to, continue to improve, driven by how we utilize our technology and how we leverage the great value that we have in the SME data set that we hold. And I'm again pleased to report the quality of those earnings sees the division deliver 95% of its revenues from the volume and more predictable and visible brands within the M&A division. So really underlying the move away from any reliance on larger corporate finance transactions and fees, which now simply provide upside opportunity rather than any downside risk. And finally, as mentioned, the rapid growth of the Knight Transaction Services business is a great example of how we can launch a new complementary service line, then be able to sell that into existing clients, existing contacts. And Knight Transaction Services, having started in July with 3 people, it's now 6, regularly billing 50k plus a month, 2/3 of that work coming from cross-sell. We've got a young and dynamic team, and there's a clear plan to grow that team, grow that revenue line, and grow that contribution. Page 13 shows the revenue and profit bridge within the M&A division, splitting out the improvement between organic and inorganic growth. And this sees revenues in M&A growing from 5.9 million to 9.8 million, with 79% or 3.1 million of that growth being organic and 21% or 0.8 million being the additive effect of the Knight Corporate Finance acquisition. EBITDA in M&A grows from 2.9 million to 5 million, with 71% or 1.5 million of that growth being organic and 29% or 0.6 million being acquired profit. So overall, margin in M&A improves as the business scales and comes out at a very pleasing 51% for the period. Page 14 then shows how the M&A business really has carried the momentum of H2 last year into H1 of this year, delivering some fantastic KPI performance, significantly up, as you can see, across the board, both in terms of the sales side of the business, which is driving new client acquisition and therefore retainer fee income, but also the operational side of the business, which is driving buyer activity and therefore transaction fee values. So new sales appointments up by 47%. That's driving more mandates into the business. So we're winning more clients than ever before. Our retainer fee incomes are significantly ahead. And remembering that retainer fee income covers the overhead base of the business. Our technology and data is driving more and more buyers into our clients' businesses. So that in turn causes increase in buyer meetings. So that's face-to-face meetings between our client, the seller, and prospective buyers. We're generating significantly more offers for our clients' businesses, and therefore we are agreeing significantly more transactions. And our transaction fee pipelines are at record ever levels, and our transaction fee income is 55% up in the period. So completing more transactions and driving more revenue through that element of the business. So revenues in the M&A division overall, 66% ahead of this period last year, which is clearly a very pleasing output for us. Page 16 moves on to the tax division and the highlights on the following page. So I think first and foremost to report that we're really pleased with the scale and the diversification which we're building into the tax division. You know, the acquisition of the Knight R&D business in July, the launch of the K3 tax advisory business at the start of H1, combined with the acquisition of Intax, which was in the previous trading period, has really broadened our services and therefore our sources of revenue. The Globe technology that we introduced into RAND in Q3 of last year is continuing to drive client acquisition and future revenues. And whilst the pandemic has caused a small reduction and some delays in processing claims through HMRC, we're currently building a strong pipeline of clients, an ever-increasing pipeline of clients, which lends to then future revenues. So really pleasing to see the K3 tax advisory team grow from the 2 that we launched within June to already 6 people. Again, revenues from a standing start are around £250,000 to £300,000 in the half, 50% of that revenue being generated from cross-sell opportunities in the group and 50% from external sources. And the period has also seen us relocate the RAND business into more suitable, modern, fitting premises for the next stage of their growth. Page 18 then shows the revenue and profit bridge for the tax division. Revenues in tax grow from 2.6 million to 4.8 million. EBITDA in tax grows from 1.4 million to 2.4 million, with the margin coming out, as we would expect, at 50%. And again, from a tax perspective, consensus for the year is around 10 million of revenue and around 50% margin, giving us 5 million of EBITDA. So given that the contributions of K3 Tax Advisory, which started from a standing start, and the Night R&D business is only 4.5, 5 months trading within the period, the teams are certainly well on track to deliver the consensus in the market. The following page then is just to highlight some of the key statistics and cover off some of the operational challenges that we've seen in the RAND business over the period. So essentially, as you see in graph 1, since we launched the Globe technology into the RAND business in Q3 of last year, it sees us continuing to win more clients into the brand. There's almost been an indigestion within that business, which has ultimately caused a slight reduction in claim numbers over the half. So you'll see in the second graph at the top right, as shown there, that whilst overall claim numbers to HMRC have grown in the period, that's partially down to the acquisition of the Night business, and actually the RAND numbers have tailed off very slightly. Part of this is down to the pandemic. Part of this is down to HMRC employing additional inspectors to challenge more claims coming through from R&D advisors such as ourselves. I would remind you that both our businesses, RAND and Night, have a very high quality line. They have a 100% success rate with HMRC. So whilst some of these claims do get challenged, we have a very strong track record of those claims ultimately being successful for our clients. So we're confident that that trend will reverse itself as we move through into H2 and next year. Positive news is that contract wins and therefore client numbers continue to grow, and therefore our if you like, latent revenues or future revenues continue to build, and we'd certainly expect this situation to naturally correct itself over the period as the pandemic comes to an end, and the business is certainly growing its client numbers very successfully. Moving over on to page 20 and the restructuring division with the highlights on the next page. So we're delighted to be reporting growth and organic growth and market share growth within the consumer business, despite what are challenging market conditions still on the back of the sort of longer than expected tail to the pandemic. So the market continues to show signs of improvement, and as we've moved through the latter months of H1, as furlough has come to an end and some of the support measures and legislative changes were unpicked, we've managed to continue to build market share in that period and see improvements in the marketplace. I think one of the highlights of the H1 period has been the continued build out of our overseas footprint, again done through key hires and office openings rather than costly acquisition. This sees us now having people in the Caribbean, Dubai, Singapore, as well as our previous offices in Cyprus. And there are some significant work wins starting to come through that network, and a lot of optimism about what we're creating and how it can deliver contribution and results in the future. We've also continued to invest in our UK fee earner base too, as we anticipate the market returning strongly post-pandemic. So really building up a head of steam, a head of capacity in that fee earner base to really take advantage of that returning market when it ultimately comes through. And whilst no acquisitions have been completed in the period, we do have a number of regional bolt-ons under consideration or in process, and we will obviously update further in due course. And again, whilst this division, very much like the M&A and the tax divisions, is built on volume, and we're talking about circa 2,500 invoices in the H1 period, just as in the M&A division, the larger and the higher profile jobs do present opportunities and also, brand awareness. Great to see the Quantum name being associated with the Derby County Football Club administration, as it brings, as I say, great brand awareness to the business. Over the page, we see the revenue and profit bridge. And again, just keeping in mind that H1 last year related to just 4 months trading of Quantum due to the timing of the acquisition, whereas H1 in FY22 is for the full 6-month period. So we see organic growth together with the revenue relating to the Aspect Plus acquisition in H2 of last year, taking overall revenue for the division to 16.6 million from the 9.3 million in the prior period. This shows almost entirely organic growth due to the 4 to 6 month comparison. But if we normalise H1 last year, so we're comparing apples with apples more, it would still show approximately 14 million of H1 last year, growing to 16.6 million this half. So again, given the challenges within the market, we're really pleased with that growth and that market share gain. EBITDA margin comes to 18%. That's a slight reduction, predominantly due to the investment in both our overseas offices and our additional fee earners here in the UK. So essentially investing ahead of demand, but delivering 3 million of EBITDA in the half. And we'd certainly, again, expect that margin to correct itself as we move forward. Over the page, on page 23 is some of the key statistics within the restructuring division. So the first graph shows the drop-off of activity within the insolvency market from 19 through to 20, and then how that has started to recover as we've gone through 21. As we came through the latter months of 21, those monthly statistics were getting back up towards those pre-pandemic levels, 1,600 insolvencies per month. The next line is how Consumer has grown its appointment numbers despite that challenging market, and therefore in turn grown its market share accordingly. In part that has been done by the statistics on the right-hand side, so growing our employee base, growing our fee earner base, more people in the business that can bill chargeable time. That staff base has grown through both recruitment, headhunting, and also the acquisitions that we've made. And we're really pleased to have that capacity now within the business to take advantage of that hopefully returning and busy insolvency market that we see coming in future months. Okay, I'm just going to pass you now over to Andy to chat you through some of the key numbers within the financial statements.
Yes, moving through the financial statements, starting on the profit and loss. As John has detailed already, we're delighted to deliver a 73% increase in turnover to 31.2 million in H1. Pleasingly, with 73% of that growth coming organically, with the acquisitions of Knight, Intax and Cayman complementing the existing group. As detailed at results, K3 now recognises cost of sales being representative of people charging time to clients. This period has seen the group increase its headcount of fee earners by 32%, up to 225 people, building capacity as the restructuring market returns, with a focus on utilisation rates through the calendar year 2022 and building ahead of the curve. In line with previous years, EBITDA is adjusted for acquisition costs. This includes deemed remuneration that we discussed at results time. This is purely contingent consideration linked to the acquisitions. Where this has a link to ongoing employment, we have to account for this as consideration, as deemed remuneration, and we strip that out. Therefore, in the period, £9.4 million of EBITDA, a 62% increase on previous year. Taxation rate looks unusually high compared to profit before tax. However, again, this is linked to the deemed remuneration. When we strip this out, because it's purely an accounting treatment of acquisition costs, we're at a much more normal rate of 19%. Although, as it happens, we do have RAND that does our R&D claims for the various software projects that we've got. Over the last 18 months, we've presented what we've described as earnings-enhancing acquisitions and accretive complementary bolt-on targets. The end result, we believe, is the most pleasing and supports our strategy, as we see headline EPS increasing by 31% from 7.2p to 9.4p in the period, having issued shares for both recent acquisitions and for earn-out payments. Swiftly moving through the balance sheet, looking at the larger movements, the increase in intangible assets clearly comes following the Knight acquisitions. With all acquired companies trading well above the acquired profit levels, we don't anticipate any future impairments. The increase in receivables come partly through acquisitions as well. Knight R&D acquired in the period with WIP and debtors of circa £2 million has caused quite a significant increase. But also, as we've talked about, with the increase in fee earners to 225 people now charging time, clearly that's seen an increase in work in progress and debtors, mainly in the insolvency restructuring division. Just a reminder that even though we changed our policy last year following audit, we still are highly prudent as a group. We account for no work in progress in corporate finance transactions until a corporate finance transaction takes place and we get paid. That won't appear on our P&L or our balance sheet. Equally with our R&D tax credit claims, until a claim is submitted to HMRC, it doesn't go into our WIP. Remembering, of course, that we've got a 100% success rate with HMRC. Even though we made the slight changes to the work in progress for restructuring, our overall WIP in that division is circa 30% of annual revenue, which compared to some of our listed competitors at 40 to 50%, we still believe is highly prudent. Moving on to cash flow, following our 2020 acquisitions, as a group, we informed investors of a move to a fixed and progressive dividend policy with a view to being broadly cash neutral over a period of contingent consideration payments. The last 12-month period has seen cash reduced by £1.3 million, largely with this deficit coming from the increase in work in progress and debtors, as I previously noted on the last slide. Outside of the restructuring group, the group remains highly cash generative with minimal working capital requirements. There's a number of initiatives throughout H2 targeting debtors, reducing debtors, driving case progression through restructuring, and making sure that there is very much full focus on cash generation. The main outflows in the period are linked to dividends, as you'd expect, with £4.5 million being paid, and also the contingent consideration or deemed remuneration of £3.5 million. Noting, of course, that our summer 21 fundraise covered all costs linked to the Knight acquisitions. We finished the period with £8.8 million of cash. Following these dividend payments, we believe that we've still got a strong cash balance, and we're very comfortable with our fixed and progressive dividend policy. If I can pass you back to John as a cap.
Yes, so just to finish off really on current trading and outlook. So, clearly overall it's been a very pleasing H1 for us, and despite the pandemic having a longer tail than probably all of us had hoped, we certainly remain confident that full year numbers will be comfortably in line with market expectations. Our M&A business sees continuing growth in those KPIs. There is no reliance now on large corporate finance transactions, and a record pipeline of transaction fees as we come into H2, which is income for the future, all really gives us strong confidence in the H2 period and in fact beyond that. The tax division, as I've touched on, it's built scale, it's built diversification with the acquisition of Knight R&D, the launch of K3 Tax Advisory. We're encouraged by that H1 performance and certainly feel that the teams are well on track to deliver market consensus. And finally, in the restructuring business, it continues to develop its fee earner base, its overseas footprint, whilst at the same time driving market share gain, all against the headwind of a relatively difficult market. And we're confident that as that market comes back, that business will continue to deliver and scale as we move forward. So in summary, a pleasing H1, a good strong start to H2, which saw the group deliver 6 million of revenue and 1.7 million of EBITDA in December, which is obviously normally a sort of shorter, quieter, festive month. And that combined leaves us feeling very confident in delivering the expectations for the year. We obviously continue to review potential acquisition targets. We now have that acquisitions director in place, which I mentioned before, and we look forward to updating the market again in due course in relation to any acquisition activity. And happy now to move into Q&A.
That's great, John. Andy, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Andy and John take a few moments to review the questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. John, Andy, we did receive a few questions ahead of today's meeting, really covering pretty much the same topic around debtors and cash. So if I just ask one question, I know you have touched on it in case there's any further clarity that you can give. Why has there been a large increase in debtor days versus last year? Will this fall as the new businesses become integrated?
Yes, hopefully I answered that question going through the balance sheets and cash flow. Some of that increase has come through acquisitions. Every acquisition we make is on a cash-free, debt-free basis, but with normal levels of working capital. So we brought circa £2 million of WIP and debtors onto the balance sheet with the Knight R&D acquisition. I think also, as we touched on clearly, by increasing our fee earners up to that level of 225 people now, 32% up on prior year, That comes with building the work in progress that will move through to debtors and then ultimately through to cash. So clearly there has been a step change over the last 12-month period. Working capital is very much something that we're looking at internally in terms of ongoing management. It's not something that gives us any concerns.
Thank you, Andy. Thank you so much. Andy, John, obviously investors have submitted a number of questions throughout today's presentation. If I could hand back to you just to read out those questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
So first question I've got here is from Paul L. Why did restructuring see only a 0.7 million EBITDA increase on 7 million revenue increase? Paul, I think probably that was submitted ahead of the restructuring section, but yeah, in the bridge it shows 7 million of revenue increase, 0.7 million of EBITDA increase. So the discrepancy really between that and the normal margin is that investment, as I talked about, in the overseas office network and obviously the people and the recruitment of those people. Clearly there's a time lag in terms of those people being hired through to when they start to build chargeable time and create revenue and profit. So that margin drag, as I termed it in the presentation, really is the answer to that. Alongside, I guess, the investing in the fee earner headcount in the UK as well. So sort of investing ahead of the curve, and obviously again there's a time lag in terms of those new staff starting to build time and create revenues and profit. So hopefully that answers the question, Paul. Question from Simon C. What lessons have you learned through the acquisitions you've made? Would you change anything or do things differently? Crikey. Thanks, Simon, for that question. I suppose probably one of the comments I would make is that we've seen that smaller acquisitions can be as involved and as time consuming as perhaps more sizable and meaningful acquisitions, and perhaps if anything it's taught us to focus on things that really make a difference and focus on bringing quality businesses into the group. I think you'll see from everything that we've done so far is that we've done them all under a very similar blueprint. So in terms of the multiples paid, in terms of the structure of those transactions, and how we pay for those transactions, they've all been done in a very controlled and similar way. I guess as M&A advisors, which is what we are, you would expect us to be relatively capable at buying businesses, and I think hopefully that's coming through in the success of the acquisitions that we bought. But yeah, certainly I guess continuing on that same blueprint, Simon, would be the key. Question from Michael D. You referenced future opportunities. What's top of the list that you're looking into? Michael, really difficult to be specific in terms of sector, because we are reviewing numerous sectors at the moment, and actually for me more important than sector is the quality of the acquisition and quality of the businesses we're looking at. I sort of tried to indicate through the presentation that whether that be a new sector, something that we're not in currently, or whether a future opportunity be something within one of our existing sectors. So whether it be a fourth leg or extending one of the legs we've got already, we are more focused on the characteristics, the attributes, the qualities of those businesses and the deals that we can construct, rather than typically the sector. I mean, clearly from a sector perspective, we want it to fit with what we do. We want it to be SME focused and be able to take advantage of the distribution platforms and the cross-selling opportunities that we can bring. But quality is far ahead of sector in my mind. So again, we'll report back in due course once we've got something more tangible to talk about. Again, I'm not sure if it's the same, Michael, but Michael, what should shareholders look out for in 2022? I mean, I guess they should look out for continued organic growth, very much a sort of key feature of our business historically and currently. They should probably look out for further inorganic growth. As I've touched on, we have a number of opportunities in the pipeline being worked on, and our acquisitions director we're working closely with to unearth future opportunities. So we are keen to continue to grow the group both organically and inorganically. They should look out for strong rewards in terms of dividends. We've talked today about, the 4p interim, the 12.1 pence proposed for the year, and that grows to 15.5p for next year. So very keen to continue to reward the support and loyalty of our shareholders. Question from Scott M. Do you see the restructuring headcount growing much further in H2? I think, Scott, as we've touched on, there is, we feel, a sort of head of steam, a bit of capacity within that headcount that we've grown quite significantly over recent periods. I guess some of the answers to that question will depend on the market. I think we've got a head of steam at the minute, and we've got an opportunity for that sort of operational gearing as the market returns. We're all keeping a very close eye on that market and how quickly that activity comes through to fruition. And obviously, we will be ready to react and go again and recruit further if the demand is there. This business is this element of the business, this division is a people business. It's driven by fee earners and chargeable time. So certainly, if the market is there, we would be keen to continue to grow that headcount and take advantage of that demand. Mark B, what are the key factors that enable you to recruit fee earners from competitors? I guess, Mark, we've hopefully proven that we are very able to recruit people, and I think look, everyone has different motivations as to why they want to join a business. We pay good salaries. We provide an entrepreneurial environment for people to work in. We reward people for performance. Obviously, as a PLC, we have the Save As You Earn scheme. We have growth shares available to us in terms of further incentivization of people. So hopefully we're proving our abilities to bring people in from all different areas into all divisions of the group. But I think, those are no doubt some of the factors that people consider. Question from Scott M. Re-EBITDA ambition. Does this require acquisitions in a fourth area, or can further acquisitions of current divisions achieve your targets? Yeah, hopefully, Scott, that's been answered in the presentation. I think, we sort of see that mid-30s EBITDA as being the sort of medium-term aspiration for the business in its current form. And in its current form, I mean sort of, a blend of organic and small regional bolt-ons, lateral hires, fee earners, etc., etc. I think in terms of accelerating the business up to the EBITDA ambitions that we have, then that will require one or two more meaningful acquisitions that, as I touched on, could either come in one of the existing three divisions, or indeed forming a fourth or in time even a fifth leg. So hopefully we've covered that off. Question from Mazin. I appreciate that large M&A deal fees are the icing on the cake. Do we have many of these in the pipeline, and are you disappointed that none have landed thus far? Yeah, I mean, the beauty of the structure of the business now, Mazin, is that the consensus in the market is delivered by the volume brands of the M&A division. And that's a far better place to be than we were maybe 3-4 years ago, when the larger corporate finance fees formed an intrinsic part of those forecasts. So I'd far rather be where we are now than where we were. And that's a testimony to a lot of hard work from the teams within the Knightsbridge business and the KBS corporate business to get us to that point. Obviously, I would far rather be sat here with those elements performing exceptionally well, and then adding that icing on the cake on top with a smattering of larger corporate finance transactions. I mean, in reality, we haven't had anything significant in the 6-month period. We have a lot of that in process, and we would certainly hope that as we go through H2 and beyond H2, that we will be able to complement the predictable, visible volume sides of the M&A business with some of those, larger and very profitable transactions as well. A question from Scott M. Are you starting to see any significant wage inflation? Thanks for the question, Scott. Yeah, I mean, we obviously see isolated incidents of sort of the wage inflationary pressure, people coming forward and saying, look, I've been offered X amount more elsewhere. And we we to date have dealt with those on a sort of case-by-case basis. Is that a quality person that we want to keep in the business, and do we need to consider that, et cetera, et cetera. I think if we look across the business as a whole, and this is excluding the recent acquisitions, but we've grown our staff base in the period by 18%, but our average salary in the period has actually stood pretty firm. In fact, it's actually down 1%. So in the M&A business, our salaries are up very slightly. In the tax business, our salaries are down very slightly. And in the consumer business, our salaries are pretty much the same. So actually, from a wage inflation point of view, the statistics say that no, we're managing to keep a good control of that. I think there's a couple of reasons for that. I think firstly, a lot of people in our businesses are driven not by basic salary, but by bonus-related rewards. So we incentivize a lot of people and pay them through sort of bonuses more so than basics. There's a lot of focus on overall earnings rather than basic salary. And I think the second reason is that a lot of our people are involved in some way or other in an equity piece as well. So, whether it be the Save As You Earn scheme, where we have a very high take-up, or whether it be the sort of growth shares, and indeed the senior people who own shares in the business, there's a lot of people that are looking at the bigger picture in terms of their remuneration and overall incentive rather than just pure basic salary. But yeah, hopefully those stats corroborate that.
John, Andy, I think you've pretty much taken every single question from investors. So firstly, thank you to all of those that have submitted questions this afternoon, and obviously to Andy and John for taking the time to give the responses. I know investor feedback is important to you, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, John, perhaps I could just hand back to you for a few closing comments.
Yeah, thanks, Mark. I mean, thank you for everyone for attending today. Hopefully you found the presentation complete and useful. Obviously, lots of information in there, trying to get through it as quickly as possible for you. But yeah, we're delighted with that H1 performance. There's a lot of positivity in the business. There's, as ever, especially given what the UK and SME world has been through in the last 2 years, there's always challenges. But yeah, we've now got a far more diversified business, a business that has real strength in depth, a business that generates its revenues across multiple brands and lots of different SMEs, lots of service lines. And we feel really confident in terms of delivering on our expectations moving forward.
That's great. John, Andy, thank you once again for updating investors. And of course, if we do see any further questions come through, we'll make those available to you after the meeting. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of K3 Capital Group, we'd like to thank you for attending today's presentation. Good afternoon to you all.